Hello class and welcome to our 12th lecture series on financial accounting or principles of accounting. And today we are starting a chapter, the last part of our asset sides of the balance sheet, which is plant, assets, natural resources and intangibles. So let's just talk about our first learning objective is measure and account for the cost of plant assets. Here we go. So cost of plant assets. So first of all, we have different names for different assets. So depreciation is the decrease in the value of the asset. So the long-lived assets are plant assets, which includes land, building machinery equipment, furniture fixtures, and also land improvement. So many of the students, they are confused between land and land improvements. We will see in our coming slides, but just for your taste right now, building your taste, that is, land improvement is, for example, anything that we, incur to protect the land, for example, building fence, making driveways, this kind of stuff, okay? So that is called land improvement. So land depreciate. Do we see a wear and tear of the land? No. So that's why we don't see land as depreciation. Plus, you have seen, or if you have your personal experience, over the period of time, the value of the land increasing, appreciate, not depreciate. Because what is the reason in economics we talk about that? Because the land has a fixed supply. We cannot increase or decrease the land. Okay, the supply is fixed, so that's why it doesn't depreciate. So that's why we don't see decrease in the value of land, so we don't depreciate it. Similarly, the others, we have building machinery, equipment, furniture and fixtures. Fixtures, for example, AC, LCD screens, monitors, the CCTV cameras, this kind of stuff, water cooler, these are called fixtures. Land improvements, we will see in our coming slides as well, but these are the things that you improve, you incur for improvement of the land, for example, building some doors, the guarding wall, this kind of stuff, we call this land improvement. And of course, it depreciates, it has a wear and tear. And the other types of fixed assets are called natural resources. For example, you have a coal mine, gold mine, silver mine, iron mine, this kind of stuff. So they deplete, they don't depreciate, they deplete. Deplete means, for example, if the company has an iron mine or a silver mine, so they estimated that there are going to be 50 tons of silver over there, and they have extracted 10 tons. So 10 tons is a decrease in the value of natural resources. We call this depletion. And the last one is intangible long-term asset, which means the nature is long-term. Their life is more than 1 year, but we cannot see them. So these plant assets, natural resources, they have a physical form, physical appearance. We can touch them. Okay? But intangible assets, we cannot touch them. For example, goodwill, company's reputation, right? Company's brand, right? Goodwill. So these are intangible assets. So the decrease in the value of intangible assets, we call this amortization expense, not the depreciation expense. The treatment is the same, just name is different. Okay, all the entries are the same. Instead of writing depreciation, we write it down amortization expense. Instead of writing depreciation expense, we write it down depletion expense, right? So don't just get confused. So depreciation is for physical assets, right? Depletion is for natural assets, for example, water well, water lakes, right? Fresh water lake, you extract the water. so it depleted. Okay, so we use depletion expense. For intangible assets, we use amortization. So the rule to find out the cost, simple. For example, how much this laptop cost me? How much this laptop cost me? All the freight charges, all the taxes, all the commission, and all the purchase price that is included. I call this is the price of my laptop. Right? Similarly, the cost of any plant asset include land, building, plant, fixtures, equipment, all those stuff. So all those, you know, all those costs that are incurred to bring the asset into its intended use, first time use. For example, you bought the plant, you paid the freight, you paid the taxes, you paid the commissions, and it is in your factory. And now you call a worker, special worker, who is going to install it for the first time use. So that installation cost is also included in the cost of the plant. For example, ACs. You bought the AC, right? You paid for the AC, the cost price. You pay for the freight transportation charges. You pay the taxes. You pay installation cost. That is also added in the cost of air conditioner. Okay, so this is what we call the cost of the AC. So whenever the question comes and says, the price of the AC is 10,000, the freight charges to brought into the factory is 5,000. So you add to the cost. The total cost of the AC is 15,000, and you paid 1,000 for installation. So total cost of the AC is 16,000, not just 10,000. Understand, everyone? Marilyn, Harry, Ella?
Yes.
Good. Let's move. Now, cost of the land. Similarly, the cost of the land includes, first of all, any purchase price, then brokerage commission, like agent fees that you pay, or if you have a survey fees as well. For example, you hire a team where it is feasible for us to locate our factory. So you hire some researcher or you hire some consultants who go to the field and survey that, okay, it is near to the market, it has a low transportation cost. Okay, over there maybe there is, government says that there is no taxes in that area. So they survey. So that survey is also included, that cost is also included in the cost of land. Legal fees that you pay for, for the court fees, right? For transfer charges, this kind of stuff. Back property taxes. Sometimes the first owner who already bought the property, they don't pay taxes. So if you are purchasing the property and you are paying taxes on his behalf, then that is also your cost of the land, right? Similarly, any expenditure for grading or cleaning or removing the unwanted buildings. So there is some kind of a hut or guest house or guard house over there. So you just destroy that one, or to smooth the land, because land is a little bit more, there's like a grass or some hard plants are there. So you just, hire the services to smooth out the land. So that cost is also included in the cost of the land, but not building the fences to protect the land. That is land improvements. That is a separate head. Okay, so many students, they are confused. Sir, we are grading and cleaning, so that should be, that is a land improvement. No, that is, you are smoothing out the land. So, and on the top of that, what you build is the land improvements, right? So you can say that the building is also land improvement, but no, because since building cost is a huge cost, so we have a separate head of building, right? So we have a land, we have a building cost, then we have a land improvement head. So we have three heads, right? Some student can say that, so this is a land, on the top of that we have a building. So we should consider it as a complete one head, land and building. So no, because due to the nature of the thing is that because land value appreciate, building value depreciate. So that's why we are taking two different accounts. Land is different account, building is different account, and improvements on the land is different account. Right? So in order to make you understand, this illustration works well. So let's read that. So we have illustration here. FedEx signs a 300,000 notes payable to purchase 20 acres of land for a new shipping site. So they sign $300,000 as a notes payable, right? Notes payable. So they didn't pay cash. They signed a notes payable, right? It's like a loan, but you need to pay them. Okay. So it's a liability. So FedEx also pays 10,000 for real estate commission. So is their land cost 300,000? No, you need to add the real estate, commission as well. 8,000 back property taxes also added. 5,000 for removal of an old building also added. Survey fees also added. 1,000 and 260,000 pavement for the parking lot, all in cash. So this 260,000 is basically land improvement. So that's why here you don't see 260,000. So the cost of the land is 324,000. You write on the balance sheet, our land, how much? $324,000. And we have a separate head as land improvements, $260,000. Understand? Harry? Naam?
Yes.
Anthony?
Yes, sir.
Good. Let's move forward. Now, what is the entry? Since you didn't pay any cash, so your liability increase, credit, your asset increase, debit. So entry would be debit to credit. What will be the entry? Land to notes payable. But entry is complete? No. Debit is not is equal to credit. Right? Then where we are lacking something? Here we go. Because they all paid in cash. Property taxes, real estate commission, property taxes, and 5,000 removal of the old building and 1,000 survey in cash. 1,000 survey fees, 260,000 all in cash. So cash decrease, credit. Now entry is okay, yes. 324,000, 324,000. Right? That's it. So we are recording purchase of the land. Purchase of the land cost us 324,000. So we have done with the land. How we are account for the land? So we have done with the concept of cost of the land. Now, cost of the building, machinery, equipment, and all those stuff.